Hello, everybody. How are we doing today? I hope we're doing good. It is, drumroll please, it's FOMC day. Not a big deal or anything, right? Just FOMC day. Just another day, a normal day out in the markets. Jerome Powell, our good friend Jerome Powell, is going to be hanging out with us here in just a little while. We're going to have him on the show. He's going to be in the screen just above me. What's up, Yoakum? How we doing? It is time. It's time. I don't know what it's time for. I have no theories about what is going to happen today. Interesting to see the market selling off here to start the day. I thought, I want to get y'all's thoughts on these things, but I kind of was thinking that maybe we would spend a little time. We've got a half hour. What's up, B-Cart? How's it going? I hope you guys are all doing good. I was thinking before we get the announcement comes here in about 29 minutes. And I was thinking before we got the announcement, we could kind of take a quick look at what has happened in the past when these FOMC announcements have happened. One thing that I've noticed, there's been tons of hot takes out there on FinTwit, on the internet. I'm sure you guys have been reading them all day. I'm sure you guys have been listening to all of the spaces that have been hosted on Twitter. People talking about their expectations for rate hikes. What's Jerome going to say? Is he going to be dovish? Is he going to be hawkish? Is he going to pivot? 50 bips, 75 bips, 100 bips. 75 seems to be the expectation, from what I can tell anyway. 75 is like, I think there's like an 86% chance of a 75 bips hike. It kind of feels like the market is pretty much expecting 75 bips, not lower, not higher. And it's all about the tone. It's all about, is Powell going to be hawkish? Is he going to be dovish? Is he going to put his foot on the gas and ram it down our throats? I really don't know what he's going to do. The data that we've been getting on the jobs front and these sorts of things is all suggesting that he's got room to push into his policy right now that maybe he didn't have previously. I mean, we're up, let's see, from the lows. I'm just looking at SPY here. And we could look at any index really, but we're up 12%, 12.15% from the relative near-term lows here on SPY. On the Qs, what are we at? Let's see here. I mean, we've gained as almost 12%, 11.4. We're currently up about, what's this, 6.5 or so. So we pulled back a little bit on the QQQ. But overall, we're gaining off the lows, and all of the data that's been coming in that could affect Powell and the Federal Reserve's decision-making process has been has been bullish as far as they're not pivoting, right? Like, all of the data suggests that the Fed shouldn't really feel like they need to pivot right now. So that's something to keep an eye on if you're expecting a pivot in this particular FOMC meeting. It sounds like that's probably not going to come based on everything that I'm reading. Curious what y'all's thoughts are. There are 68 of you guys here, and I've heard from 2 of you. So what gives? I'm over here saying hello. Say hello back. I want to talk to you guys. I want to know who's here. Where are you watching from? What are your expectations? I'd like to have a little conversation with you guys before we get the data back or before we get the announcement. And then so we get the data, or we get the announcement here in about 25 minutes, and then Powell is going to speak at 1:30. And we're going to hang out and watch him. What's up, Enigma from SoCal? How you doing? Hope all's well in SoCal. What's up, Tom? Yo. What's up, Rob? Jedi? Christian? RC? Hi from Raleigh. Cool. Thanks for tuning in, guys. I appreciate it. Jedi, you're a little worried? Excuse me. We got some New Orleans in the house. Christian from Switzerland, one of my favorite countries in the whole world. I love Switzerland so much. I just wish I could live there. Trade Janice, what's happening? Enigma wants 50 bips. 100 calls on 387 strike. Want to see big green. All right. Well, I hope you get it. Dwayne, what's up, man? Hope you're doing good. Callie in the house, here for crypto. Nice, right on. That's a good reason to be there. And the beautiful mountains and rivers and lakes, I would hope. The landscape is pretty lovely there as well. I hope that you are taking the time to enjoy that. Bullish, baby. Tom's bullish. Uneasy market time. J-Rock steady. What's happening, J-Rock? Yeah, I hope you guys are all doing good. So I wanted to take a minute before we... well, hold on. Let's see. How do you think total market's going to look after? What are my expectations? I try not to come into these things with expectations. I try to just let things play out how they're going to play out. My intention is kind of to stay on the sidelines today. I've been on the sidelines all week. I don't know if any of you guys follow me on Twitter, but I've been very busy with work, but then I've also just kind of been feeling like I just don't know what I want to do. So I've been chilling on the sidelines. I think I'm gonna wait unless something crazy happens. Now I do have bids. I have bids very, very low on ES, like 36, 60 ish, but that's like I don't necessarily think those are gonna hit. I just kind of have them there in case we get some sort of little flash crash. I think with the market feeling like, or the general consensus is that everybody is expecting hawkishness and they're expecting a 75 bips hike. That's like across the board. Everything that I've been listening to today, everything that I've been reading this week, that kind of seems to be the expectation. So if he comes out with that, and that's already the expectation, I have to assume some of that's already priced in, if not all of it's already priced in. So I kind of leaning a little bit more bullish personally, but I guess we'll just have to wait and see. I think next week is going to be very important, though. Something that people are talking about quite a bit, but they're not talking about how it's going to affect markets that much, is the midterms, and it kind of seems like. Yes, Christian, we're definitely going to watch that for sure. We'll be, as soon as he comes on, he'll be just above me in the screen just above me, and I will shut up and we will listen to him only. I think the midterms are going to play a pretty big role in the markets here next week. So I'm almost more interested to see how the midterms go than I am about FOMC, only because it just feels like everybody already knows what's going to happen. It doesn't seem like Jerome's going to throw us any real curveballs. I think if he throws us a curveball, I think it's going to be a pivot. And if he pivots, then the market's going to love that. So I would expect the market would love that. So, but I don't expect him to pivot. So I don't know. That doesn't really give you too much, but that's kind of where I'm thinking. AJ, how are people still buying houses? I could understand why people would buy houses right now. Everybody's scared. The rates are really high, and at least in my area, prices have come off, pretty decent percentage, 10, 15%. If there's a pivot in the rates, they might be getting a decent deal right now. I don't know. TrendSpider level 2, Mike. No, we do not have level 2. However, we have things that we're working on. We have a new product called SignalStack. SignalStack is going to be it is an order router. So, it's early. That product is early. But it's going to allow you to essentially utilize the trading bots feature to place trades directly into your broker. I don't want to speak to all the functionality that's going to come over time with SignalStack, but I would imagine there's a decent chance that you might be able to one day bring your broker into the TrendSpider platform, and then you can utilize your broker's level 2 data. But at this time, TrendSpider does not offer level 2 data. I don't know that we'll ever offer standalone level 2 data, but maybe. I'm not sure. Let's see. Joining from Chi-Town, Thoughts Couture. Thank you for being here. Thought Couture. George or Jorge. Nothing to get the blood going like some nice heavy lottos. Let's go. What's up with the Apple factories in China? Yeah, I just kind of was reading about that before I got on here. I don't know too much about it. But I saw they shut down some area where Apple does a lot of their work, so that's not great. All right, so real quick. Thank you all for being here. Again, I really do appreciate it, and I look forward to spending the next hour or hour and a half or so with you guys. Before we get to the announcement, I want to talk through a few things that we've added to the platform recently that I think that you guys might be interested in. Let me see something real quick here. Yeah, so first new feature that we have recently added to the platform. What's up, Vibrance? Hope you're doing good. Is auto chart pattern recognition. Now, this is pretty dang cool, in my opinion. So many traders use chart patterns to make trading decisions. And, the thing about chart patterns is you're kind of constantly... different traders see things different ways. So sometimes it could be a little bit difficult to determine, is this a rising wedge? Is this a symmetrical triangle? Whatever, what have you. The chart patterns is going to automatically discover these things for you. Currently, right now, we just offer discoverability on triangles. So ascending triangles, descending triangles, and symmetrical triangles. I'm going to show you another feature here in just a little bit that helps you find some other patterns too. But this is what the chart patterns feature does. The chart patterns feature is going to be expanded upon. We are going to add a lot of different chart patterns to this, but for now, we have just auto recognition of these three types of triangles. So what I want to show you is how you can easily find them. Boo, spam! Get out of here with the spam. In the market scanner, if you could turn on your market scanner and you type in triangles, we've got a ton of shared scanners. And these are available for every TrendSpider user. If you are a TrendSpider user, you can access these shared scans. And you can see here, there's a bunch of different ones. Any triangle breakdown, breakup exists. Any triangle in force, meaning price is within it. Ascending triangle, breakup, breakdown, ascending triangle exists. And we have these settings for each of the triangles. So if you're looking specifically for a symmetrical triangle breakup, select that thing. It's gonna preload the conditions in the scanner for you. It's gonna be scanning through the S&P 500 index. You can change this if you want to a different index. I'm gonna run this scan just so that we can see any names that are meeting this criteria right now. I'm not sure if there's anything, so we may not find anything, but we're gonna run some scans until we find some things. I just wanna show you guys what this looks like. Here we go. So there you go. Pretty cool. You have a symmetrical triangle and price is broken through it. Now this is a pretty intense one. Obviously the trade is dead. You can't really take a trade there, but something like this is pretty interesting, right? You have your symmetrical triangle, you have prices broken out. Depending on the type of trader that you are, maybe you want to buy a retest of this particular line. Well, if you want to do that, you just go in, you create a new line at that spot. Right click on it, say create alert, touch bounce, use your sensitivity, change your confirmation candle. If anybody has any questions about this, do let me know. I'm happy to walk through this more slowly. Choose your expiration date, your triggers, create alert, boom. Now I've got an alert on the top line that we just broke out of. Oftentimes old resistance comes new support, and maybe that's what we're going to find here. Maybe we're going to get a little bit of a pullback. It's going to come back into that descending trend line here that's at the top of the symmetrical triangle, and then it's going to bounce and maybe go a little bit higher. That is the idea, right? Like that's kind of what a trader might be looking for. Now you could also, if you wanted to, let me go back to triangle. I'm going to go to triangles in force. Because with triangles in force, it hasn't broken up or broken down yet. Price is somewhere in the triangle, right? And this might be even more interesting to you. Maybe you want to try and catch that particular move out of the triangle, but you just need to find the names that that the triangles are occurring on. This scan is going to help you find it. And once it completes, we'll have a list of symbols that are meeting the criteria. And again, we can create alerts on those lines super easily and be alerted if price breaks up or down. So this is super helpful functionality in my opinion. Let me see here. While this is looking, I've got a bunch of random names up on my watch list here. Let's see if any of them are hitting. So the way that the chart patterns work, they're not just a scannable thing. They're actually indicators, right? So here in my indicator list, let me move price action down a little bit so you can see. I've got triangles ascending, triangles descending, triangles symmetrical, and I have them all turned on. So if the platform were to find any of these triangles on my chart, it would automatically draw them. I wouldn't have to necessarily scan for them. So here's one. This looks like this is a descending, or rather ascending triangle, sorry. Ascending triangle, price stuck in between. And this is a pretty nice little tight pattern. You know, you might want to create an alert on something like this. So again, you just draw your line, right click on it and create alert. Makes it super easy to be alerted on these sorts of things. And you know, you could spend a long time going through a lot of different charts looking for these sorts of patterns. Here's one that looks pretty good. This Mosaic company kind of consolidating right below that downward sloping trend line. Maybe the earnings announcement is going to give it the strength it needs to make a move in one direction or another. Be something to watch for sure. But yeah, the whole idea here, just trying to create tools to help you guys find things more easily, make more educated decisions, and just take a lot of the load off, take as much of the load off as possible. It can take a long time to go through all of your charts and try and decipher, you know, where is the pattern? What does the pattern look like? The platform's just going to automatically do it for you now. And like I said, we're going to be adding to this functionality quite a bit. There's going to be a lot of different patterns showing up here in the not so distant future. Think about all of the other chart patterns you might be interested in, head and shoulders, channels, these sorts of things. A lot of that stuff's going to be discoverable here soon. Now, one thing I want to note to anybody who's interested in this tool, sometimes you're going to see something that looks like this. We've got two triangles here. So I'm going to open up my indicator list again and notice how the descending ones are in blue and symmetricals are in green. So there's actually a descending triangle and a symmetrical triangle here on this particular chart on this time frame. So it's automatically finding both of those for you. Super powerful. Love this feature. Specifically, I love this feature for the scanning because, you know, obviously having it automatically draw them on your charts is one thing, but being able to scan for these things and take all of the guesswork out is a whole nother thing. This is going to make your life so much easier. Well, at least we hope. We hope that this makes your life so much easier. That's what we're going for here. Let's see. Does it also work for crypto? Of course, man. Let's see if there's anything in crypto land. Actually, let me do this. Crypto. Oh, nope. Those are stocks. Coinbase. Let's do this. Yeah. So here's one on Bitcoin. Little descending triangle that has price has recently broken out of. And I could go through these if you guys want me to. I don't know if there's anything else on this particular time frame. We could, of course, scan crypto if we wanted to, I suppose. Obviously, a lot of crypto is pretty flatlined right now. Let me try a smaller time frame here. At least flatline on the bigger time frame. Or, yes, on the bigger time frames. So here's a little descending triangle on Doge we've broken out of to the upside. So, yeah, absolutely works on crypto. Works on any chart. Super cool little feature. What else, guys? Sonia, what's up? Good to see you here. Hope you're doing well. Daniel Gomez, what's up? Will a 75 BIP rate hike affect the market? It's a glorious question, sir. We don't know. We're about to find out, though, aren't we? Let me go back to my butts and index because I am noticing I've got another screen here that I'm looking at. And I am noticing that we are getting a little bit of a move here on ES over the past couple of minutes since I've gone live. I think I'm good luck. I brought the good bullish energy to to the futures here since I've been live. So what are we thinking, y'all? This is, do we like this new chart patterns feature? Do we have any non-TrendSpider users in the house? There's a bunch of y'all here now. Is anybody who's tuned in not yet a TrendSpider user? Did you miss? If you are not a TrendSpider user, did you miss our crazy deal that we just offered for Halloween? Because it was a pretty crazy deal. It was like an awesome deal. Non-TrendSpider user, Oscar. Oscar, why are you on the fence, sir? What are you waiting for? Talk to me about what you would like to see. What would get you interested in the TrendSpider platform enough to use it? Lair, Austin, bro, I'm sorry. Rilker, awesome, man. Hey, I remember you. Hope you're doing good. It's been a long time since I've seen you around, but I hope you're good. How crazy. It was like trade Janice. It was like 62% off. It was like $170, $180 for a year. Yes, Mike, real time, for sure. Austin, bro. Is it Lair? Is your first name Lair? Is it Austin Lair or is it Lair Austin? Future is moving here. A nice 20-point rip. For anybody who was long, congratulations. Oscar, the deal is over. It ended yesterday. I can secretly, privately, in front of all of these people tell you that we've got another one coming before the end of the year. That's what I can tell you. It's just Lair. Got it. Okay. Is it better than Thinkorswim? I mean, in my personal opinion, hell yeah, it's better. Rocket. Mike, you might be onto something there with that. You might be. I can neither confirm nor deny. Degen TradingView user. Well, there, we'd love to win you over. So you let us know what TrendSpider would need to get you to make the switch. Be curious to know. You can always hit us up. So down here in the bottom right-hand corner where it says contact us, this little button's available even on just TrendSpider.com. So you can always reach out to us and be like, hey, I'm not a TrendSpider user, but this is what I'd like to see on the platform. Oscar, come climb over the fence, bro. The fence is very short and it's very easy to climb over. You should just, boop, just do a little hop. Nice, boss lady. Well, I'm really happy to have you here. You used to be a user, but your main trade is a yes, so that's interesting because now, do you see what's on my chart right now? On my chart right now, live ES futures. Thank you so kindly to our good friends at CME Group. We are very lucky and fortunate to be able to offer live futures to all of our users now. So if live futures was the thing that was kind of keeping you from getting on TrendSpider, we got them now, homie. Would love to have you back if you'd be into it. So I mentioned we've got 7 minutes here before the announcement. Price is going to start being pretty wild. I want to show you one other thing real quick because this is super, super cool. I don't know if this is something that you guys are interested in trading, but I want to show you anyway. We've got this new indicator. It's called, let me see here. It's called fractal trend lines. Now, these fractal trend lines are pretty interesting for a number of reasons. I'm not going to go in depth on them, but what they allow us to do, if any of you guys are broadening range pattern or broadening pattern traders, these fractal trend lines now allow us to scan for broadening ranges. So if you go in your shared scanners list and type in broadening, I've got a handful of things here. So on your end, if you have not played with this yet, you're going to see like two things. You're going to see this one and you're going to see this one, broadening formation detection. The only difference between these two options, you'll notice here is the length of the length on the fractal trend lines. On this one, it's 13. On this one, it's 23. So what these are looking for, I'm just going to show you real quick. I'm going to run this scan so you can see. This automatically finds broadening ranges on the chart. Check this out. Now, in some cases, actually, let me do this real quick. Let me make sure that my indicator has the right length. Ah, it does not. Okay, so let me do this. Changes to 13. Now, in some cases, you're going to find price like inside of the range. You may see it at, like in the middle of the range, right? And if you are a broadening range trader, that is probably not going to help you out too much. But sometimes you're going to find stuff like this, where price is like right at the bottom or right at the top of the range. And CLH, oh, Schwab is a good one that I found today. Check out Schwab right at the top of the broadening range there and consolidating. If this thing makes a move lower, this could like really make a move lower. Pretty interesting look here. It looks like Microsoft has one. Let me remove this so you guys can kind of see it. The trade that I actually took yesterday was NCLH. Yeah. Check this trade out, y'all. How clean is this? And this came up in a scan yesterday. Clear topping, you know, if you're into these broadening ranges, clear opportunity to go short, maybe with a stop above yesterday's high or something like that. Pretty nasty little move. Almost a buck lower from today's lows to yesterday's highs. Super, super clean. Super clean look here and just like instantaneous to find. No more searching around for these broadening ranges on your own. And the thing is that you can do with this. So the way that this scan is set up, it's just looking for, we have an upper and a lower line, and then you have price is greater than the lower line and price is less than the upper line. So price is somewhere in the middle. Well, we can take these things a step farther. Like I've created a couple of my own, where we're looking specifically. Now, we're not going to get as many results with the ones that I've created because they're so specific. But we've taken those 4 conditions from the shared ones, and I've added that price is within range of, let's say, the lower line here. And I'm defining that as a very small value, in this case, 0.5%. So price is within 0.5% of the lower line. We're looking for above average volume on the current candle, and then we're looking for just a specific volume value. So I'm filtering, you know, I'm looking for setups that are like very specific to what I would actually want to trade. And what I would actually want to trade is price coming up into or coming down into the top or the bottom of that expanding range or that broadening range. Super, super powerful scanning capability here. We haven't even really announced this. I think this is maybe like the announcement of this. So I would encourage you guys, if you are users and you're curious or you do trade broadening formations, super powerful little functionality here that you can scan for these now. If you're a strat trader, I know there's tons of strat traders out there, and I know you guys love your broadening ranges because you're always looking for exhaustion risk to the upside or to the downside. This is a super, super easy way to find it. Niranjan, looks like Brett is answering your question there, but yes, you would futures, you do have to pay for futures, but if you have a discount on your account, then you get that discount for your futures cost too. So it's super, super cheap. I mean, over the long term, it's super cheap and very much worth it. 2 minutes, I'm going to go over to what I'm going to do actually. I'm going to utilize another feature that's relatively new to the platform. I'm going to use multi-chart view here. Let me go to the 3. And what do you guys want to watch? Would you prefer to watch the ETFs or would you prefer to watch the futures? Move this, move this. Do you guys have a preference? I want to watch whatever you guys want to watch. So right now I've got it on ETFs because I feel like more of you are probably ETF traders than futures traders, but I don't know for sure. Yeah, hold on. Let me throw up a couple other things. Let me throw up. So I'm going to throw up UUP here. This is the dollar index. And let me also do, actually, let me do this. All right, so here's your 75 bips hike. I have to assume this is 75 bips. Let's go look at Bitcoin. Here's your big expansion of the range. Let's watch VIX. Actually, let me see here, UVXY. Let's do that. Sorry about that. Just try and get that all set up for you guys. So indices so far digging things. IWM, QQQ, and SPY all ripping. The dollar is failing. And Bitcoin. Bitcoin's liking it so far. VIX is falling. Yeah, Rilker. So we don't have DXY on the platform, the index proper. But we have UUP, which is right here, kind of behind my head. I'll move it as best as I can. I can't really adjust this too much. So far, markets are pleased. What do we have? Does anybody have was it a 75 bips? Is that what they gave us? I assume that's what they gave us. Future's definitely ripping. Wow, what a move. Did anybody take calls? What's up, Lols? Did anybody have calls going into this? Please tell me that some of you guys had calls going into this. I want to see you guys winning. Spot only. Well, that's safer, right? I did secretly take a few things. All right. Blind trader, long TQQQ. Nice. Trade Janice took XPX from 50MA. Manny, nice. Oh, Mike. Puts. Bummer. Now, I will say, this is kind of action that's counter to what we've seen the past couple of these, right? The past couple of these, we've seen the market sell off on the initial print, and then Jerome has come in and helped save it. LOLZ, LOLs. I think that the reason why things are gapping up or why they're moving higher is because people really anticipated this. I think the general consensus from market participants was that 75 bips was going to be what was going to happen. I don't think anybody's super surprised. So that's probably why the move higher. And now it's going to be all about Jerome. It's going to be all about what he says and how he comes off. If he's going to be more dovish or if he's going to be more hawkish. That's really what now everybody, I think, is waiting to see. Yeah, sure, right? Algos too. I mean, algos are really the ones doing all the work for the most part. It's not me and you and Joe Schmo Retail. Google calls, Justin, nice. I've actually got some of those myself. And you're right. The market could totally turn once Powell starts talking. And kind of like I mentioned at the beginning, you know, what the suggestion from the smart people in the room that I listen to is that he's probably going to come off pretty hawkish today because he feels comfortable in doing so. I mean, he's been very, I don't know if you guys have been like, have listened to the last couple of events or pressers that he's held, but he's been very hawkish. He's been very serious about we are going to do everything we have to do to get inflation under control. And, you know, he has not minced words, or he hasn't really stepped away from that tone. So it would be a surprise to hear him step away from that tone today with the data that we've got this week with jobs are strong and these sorts of things. I mean, all the data points to him having confidence to continue his firm press into rate hikes. Manny, you think he's going to come off dovish. All right. That's interesting. What's up, Lori? Hope you're good. Now, I will say, I've got, like you can see above me, I've got the Powell speech here. He should go on at 2:30. Sometimes for whatever reason, sometimes this thing does not update me. I'm going to I'll be refreshing at 2:30. But if for some reason it starts and I don't have it up, just let me know, y'all, that it started. But I should be able to manage it, no problem. Fed hints at slower pace of rate hikes per Bloomberg. Well, that is not bearish. Look at IWM over here making a new high. IWM just absolutely been leading. I don't know if you guys have been watching. I mean, DIA too. I should probably add that. Let me go here and add. Yeah, DIA. Been a ripper. New sentence in the FOMC statement signals more increases, but hints at possibly smaller increases. Huh. Interesting. But more of them. So does that suggest that they're going to keep pressing into 2023? That's kind of what that sounds like, isn't it? Yeah, I mean, we may chop. I don't know. I think it's all up to Jerome here. Everybody's waiting on Jerome. It's going to be really up to him. He's going to call the shots. This initial reaction looks good for bulls, but I will say, you guys know, the past couple of these things, they've sent it lower initially, and then hit whatever he had to say is what's turned it around. I believe it's past 4 of them. April, May, July, and August. It would be a funny thing if that changed today. I hope it doesn't. I want to see markets keep gaining. Seriously, he's a powerful dude. I can't imagine what it's like being in his shoes. I couldn't handle it. Sonia, you're looking for SPY 391. Where are we at right now? 387. You think we're going 391 today, Sonia? Greg, you're absolutely right. He could do it. He could really do it. But at the same time, it all comes back down to expectations, right? If the market assumes what he's going to say and then he says what they assume, I don't know. I don't see a ton of room for downside if that's the case. But we're going to know here. He's going to be live in about 20 minutes. While we're waiting for Jerome, does anybody have any questions about anything? What up, Brayden? How we doing? Hope you're doing good. We are having fun, man. It's always fun being live. That's a good question, Greg. I don't know. I mean, I kind of tend to assume that none of these people write their own stuff. He's got bigger fish to fry. He's got to deliver the message. So I don't know. That's a good question. I mean, he would probably be most able, but I don't know. Any questions about TrendSpider? Any questions about the platform? Any of the new functionality that we've added to it recently? Obviously, we've talked quite a bit about it here. Words and tone definitely can change the impact for sure. For sure. I mean, live futures, this is a huge addition. I don't know about you guys, but man, once I kind of realized like how important futures are to the whole thing. I don't know how I didn't realize this just like instantly when I first started trading, but it took me some time to realize it. But having them on the platform now is so helpful for me because they're pretty much what I trade, futures and indexes. So if you haven't yet, if you're a TrendSpider user and you have not yet, if you've not yet subscribed to futures, man, you're kind of doing yourself a disservice. It's really, really helpful to know what's going on with futures. With all the gap ups and gap downs that we see on SPY, QQQ, IWM, knowing what's going on with futures is so helpful. Does it take into consideration dark pools? That's actually a really good question. That would be probably a CME group question because I really don't know it. But you could go to CME Group's website and find out the answer to that. And I could find out for you and let you know. But I'm really not sure. I wish I knew. Mr. Hedge Fund, glad you're digging the live FUTs. It's just so helpful to have them. It's so helpful to be able to see them. Because I would get so stuck with gap ups and gap downs on the ETFs. And it's not to say that it's not helpful to know where those are. It certainly is, because they can impact price too. But knowing why they exist, which is because of futures, and knowing what futures did during that time is really, really nice. So now, guys, we wait. We got about 17 minutes before the presser with our old buddy, Jay Powell. I'm really excited to hear what he has to say today. I think he's going to come out swinging. Can seasonality support a bullish week this week or next? Dwayne, what a question. Let's take a look. One of the many awesome features on TrendSpider is seasonality. You can find seasonality over here in the sidebar. For those of you that don't know what seasonality is, it's just a measure of how a stock performs over a period of time. I'm going to go to, let's just go to SPY here while we wait for our man. So you can break seasonality down into months of the year, weeks of the year, days of the week, hours of the day, and you can see how it performs based off of particular metrics. So change percentage greater than 0. Essentially what this means is, does a month close green or not, right? If it gains on a month, That's a check in the green box. And then if it doesn't gain on a month, that's a check in the red box. And over, a long duration of time, in this case, since 1993, we're able to see very quickly how does SPY perform in the month of November. So currently has a 77% win rate since 1993. You're talking about, what's that, almost 30 years of data. In that 30 years, 77% of November's closed green. Pretty strong monthly close there on SPY. Really, the strongest month of the year is November. April also has a 77% win rate on the SPY. If we go to QQQ, we check that guy out. 71% win rate. Also the strongest month of the year. In tandem with July. So July and November, two strongest months of the year since 1999 on the QQQ. We do have that decreases. That strength decreases into December, 52% win rate in December on the Qs. And then on SPY, it is a 69% win rate. So kind of decreases. And then you have IWM. IWM, clear winner is November. So historically speaking, we're looking back 20, sometimes 30 years here. November, strongest month of the year across the board for the ETFs. That is something to think about for sure. And we know that strength weakens into December at least a little bit, specifically on QQQ. Let's see what the story is with DIA since 98, 78% win rate. No, 76, sorry. 76% win rate. Same as April, strongest month of the year. And then that drops a little bit in December. So, back in September, we were talking about September because September is historically the weakest month of the year for most of these indices, or it's relatively close to the weakest month of the year. If it's not the weakest, it's like the second weakest. We were talking about buying September weakness, selling into November strength back in September. Maybe we're going to get the opportunity to do that again this year. It's kind of what it looks like, isn't it? There's a bunch of other values that we can measure. It's kind of cool. Relative volume greater than 1, so just above average volume. What months have above average volume on average? Then we have 2x average volume, relative volume greater than 2. That's 2x average volume. RSI above 70, RSI above 50, RSI below 50, RSI below 30. Money flow index above 50, money flow index below 50, and then price above SMA, the 20 SMA, the 50 SMA, the 100 SMA. So lots of different ways you can measure seasonal strength on these, on any ticker. Super cool feature on the TrendSpider platform. Futures also is better for tax management. You're right. That's true. And you don't have, what's it called? You don't have decay. So you're levered, but you don't have decay. All right, so we're selling off that initial move here so far. The dollar not really rebounding to the same degree that the indices are selling off. I'm going to use a different Bitcoin chart here. That's not a good one. Let's use Coinbase. Yeah, it's a little bit cleaner looking. Just more activity there. How many minutes do you boil an egg for? Man, I don't know. Yeah, you're welcome, Dwayne. Happy to share that tool with you, sir. Oh, hells no. How many minutes do you boil an egg for? I don't know. My good friend Kess posted something recently about the same boiling water that makes an egg hard makes a potato soft. I thought there was something to learn about that. I don't really know what, but there's something there. What do we got? 11 minutes. Let me do a little refresh here. Make sure our man's not talking. Ask Alexa. I don't think it's that long. I don't know. I don't like hard-boiled eggs personally. I think they're kind of gross. It's the texture. I can't do it. It's too slimy. Cold water. Bring to a boil. Cover and remove from heat. 10 minutes. Yeah, always best to start with cold water. Where's JPow? We want JPow. So SPY and QQQs kind of just like they look like they're flagging out to me. Bitcoin holding in better than SPY and QQQ. Of course, these are just 1 minute charts, so we got to keep that in context. Those Google calls probably working out for you. Google trading up a little bit. I'm just looking over here on my side. Just making some adjustments. Give me 1 second, y'all. So what are we thinking, guys? What is our game plan? Are you guys going to be trading while Jerome's talking? Are you guys going to sit out? Casio de Pepe? Bread. Don't get me excited over here, bro. Hit us with the recipe. Let's go, Christian. That's what's up. Right. That's that is what's tricky, blind trader. Only if SPY above 420. All right. Fine. I guess we got to wait. Do love me a good simple Italian meal. So we got a couple people who are in long trades right now. Do we have anybody that's in a short trade? I know one of y'all is. Don't lie about it. Just be honest. Tell us the truth. Braden. Braden's short. Short from 95, though. What are we trading right now? 86? 85. Hey, you got 10 points. Vishal just went short. Okay. You guys some cowboys. Nancy, you're in Tesla calls. Which ones? Zero or hero, baby. I know that's not true. It's more like negative 10 points or or not, or positive something. It's negative 10 points and get stopped out or hero, baby. I think it's probably what's more accurate. Am I right? 6 minutes. 6-minute warning. Jerome's usually late, though. The man's a busy man, and he's usually late. True. Yeah, see, I know you, Braden. You're too smart for that. Let's actually see. You know, Dwayne mentioned, when he mentioned seasonality, he mentioned weekly, and I'm sitting here looking at the monthly. So I apologize, guys. So this is kind of interesting. On QQQ, next 2 weeks, historically, since 2003, 20 years of data. Next 2 weeks are kind of weaker, and then we have a really strong week on the 48th week of the year. This is probably like last week in November, which that makes sense. Kind of around Thanksgiving, Black Friday times. Bart Simpson pattern. Quick spike up, sideways, then drop. Yeah, you think so? It does kind of look like Bart Simpson's hair, doesn't it? 2:30 November 4th on Tesla. All right. It's trading, what, 225 right now? You can get that. November 4th. You need Powell. You need Powell to come in and save the day. He's either going to make us or break us. Long AMD. Dwayne? All right. What's up with AMD? What do we like AMD? They had earnings, right? Yeah, yesterday. What you targeting on AMD, Dwayne? You know, look for this gap fill up to 68 or something. 4 minutes for our man, Jay Powell. Thank you to everybody for sticking around and hanging out with me. I appreciate it. I am updating like a madman over here, refreshing this Federal Reserve page. I don't want to miss a thing. Everyone I knew was watching this 54 level somewhere in here. And man, they nailed this, didn't they? Almost to the penny, that retrace. Really nice if you got it at 54. Fantastic trade. If you did. Let me check out and see what's going on here. Looks like things are gaining again. IWM, new high. Bitcoin looking like it wants to gain. SPY lagging a little bit. QQQ lagging a little bit. DIA lagging a little bit. Man, this IWM, just small caps. So strong. Braden, they're coming up into your 95, aren't they? 93, 38.93 over here. I assume you're trading ES, right? We got 2 minutes. 2-minute warning, everybody. 2-minute warning. And it will take me a moment to adjust the audio. So just a heads up. Actually, I'm going to go ahead and turn off this music real quick. There we go. Why am I still hearing music? I'm still hearing music. Oh, I'm hearing music over here on this bad boy. I see. This is the FOMC music. Okay. So let me do this. Can you guys hear that? The FOMC music? Isn't that just lovely, peaceful music that they give us from the FOMC? It's so nice that they greet us with such warm, happy sounding music right before all the stress. Here we go. We're live. I'm going to shut up now. Good luck, guys. Right, vibrance. Too loud. Ooh, all right, hold on. Fix that. I'll adjust accordingly. All right, we just made new highs on all the indices, and now they're selling off a little. Oh, come on.
Good afternoon.
There we go.
My colleagues and I are strongly committed to bringing inflation. We have both the tools that we need and the resolve it will take to restore the Federal Reserve and serves as the bedrock of our economy. The economy does not work for anyone. In particular, without price stability, we will not achieve a sustained period of strong labor market conditions that benefit all. Sustained period of strong labor market conditions that benefit all. The FOMC raised our policy interest rate by 75 basis points, and we can. The FOMC raised our policy interest rate by 75 basis points, and we can. Increases will be appropriate. We are moving our.
This is crazy.
Increases will be appropriate. We are moving our. That will be inflation to. Are maintaining a restrictive stance of policy for some time. We will require maintaining a restrictive stance of policy for some time, reviewing economic development.
Oh man, this is frustrating.
More to say about today's monetary policy actions after briefly reviewing economic development. It has slowed significantly. Page rose.
What is going on?
Change so far this year. Indicators point to modest action. But is unchanged so far this year. Indicators point to modest action. Growth in consumer spending has slowed from last year's rapid pace, in part reflecting lower real disposable income and tighter financial conditions. Significantly, largely reflecting higher mortgage rates. Higher interest rate growth on business fixed investment. Extremely tight. Year low, job vacancy.
This is not good, y'all. All right, I'm going to try refresh.
Month over August and September. Although agencies have moved below their highs, month over August and September. Although agencies have moved below their highs from earlier in the year, the labor market continues to be out of balance, with demand substantially exceeding the supply of available workers. Participation remains well above our longer-run goal of 2%.
Seriously, that's what's happening.
Prices rose, supporting the volatile food and energy categories. Core PCE prices.
Oh man, this is so frustrating.
Prices rose, supporting the volatile food and energy categories.
Yeah, you think this is by design?
0.1%.
Roman?
And the recent inflation data again have come in higher than expected. Price pressures remain evident across a broad range of goods and services. Russia's war against Ukraine has boosted prices for energy and food and has created additional pressure on inflation. Despite elevated inflation, longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. But that is not grounds for complacency. The bout of high inflation continues, the greater the chance that expectation will become entrenched. The Fed's monetary policy guided by our inflation will become entrenched. The Fed's monetary policy guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship to meet the higher costs of essentials like food, housing, and transportation. As it erodes, able to meet the higher costs of essentials like food, housing, and transportation. At today's meeting, the committee raised the target range for the federal funds rate by 75 basis points. The process of significantly reducing the size of our balance sheet.
What is going on?
Basis points. The process of significantly reducing the size of our balance sheet, which pays action. We've raised interest rates by 3.75 percentage points. Anticipate that ongoing. With today's action, we've raised interest rates by 3.75 percentage points. Anticipate that ongoing increases in the target range for the federal funds rate will be appropriate in order to attain a stance of monetary policy that is sufficiently restrictive to return inflation 2% over time. That is sufficiently restrictive to return inflation 2% over time. Have tightened significantly in response to our policy actions,
I'm glad it's not just
and we are seeing the effect of demand in the most of the economy, such as housing. It will take time.
Shiv Kumar, you got a better link for me?
Restraint to be realized, especially on inflation. Why we say in our statement that in determining the pace of future increases in the target range,
CNBC
we will take into account the cumulative tightening of monetary policy and the lags with which monetary policy affects economic activity and inflation.
Oh, DMs.
At some point, as I've said in the last two press conferences, it will become appropriate to slow the pace of increases as we approach the level of interest rates that will be sufficiently restrictive to bring inflation down to our 2% goal. There is significant uncertainty around that level of interest rates. Even so,
I'm going to try something real quick, y'all. I'm sorry. Apparently this one's working.
For the outlook for economic activity and inflation, we will continue to make our decisions meeting by meeting and communicate our thinking as clearly as possible. We're taking forceful steps to moderate demand so that it comes into better alignment with supply. Our overarching focus is using our tools to bring inflation back down to our 2% goal and to keep longer-term inflation expectations well anchored. Reducing inflation is likely to require a sustained period of below-trend growth and some softening of labor market conditions. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices in the longer run. The historical record cautions strongly against prematurely loosening policy. We will stay the course until the job is done. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you, and I look forward to your questions.
Thank you, Colby. Thank you. Colby Smith with the Financial Times. On the need to slow the pace of rate increases at some point, is a downshift contingent on a string of better inflation data specifically between now and, let's say, the December meeting? Or is that something that the Fed could potentially proceed with independent of that data, given the lagged effects that you mentioned?
So a couple things on that. We do need to see inflation coming down decisively, and good evidence of that would be a series of down monthly readings. Of course, that's what we'd all love to see, but I've never thought of that as the appropriate test for slowing the pace of increases or for identifying the appropriately restrictive level that we're aiming for. We need to bring our policy stance down to a level that's sufficiently restrictive to bring inflation down to our 2% objective over the medium term. How will we know that we've reached that level? Well, we'll take into account the full range of analysis and data that bear on that question, guided by our assessment of how much financial conditions have tightened, the effects that tightening is actually having on the real economy and on inflation, taking into consideration lags, as I mentioned.
Nice, Braden.
We will be looking at real rates, for example, all across the yield curve and all other financial conditions, and as we make that assessment.
Hi, Howard Schneider with Reuters. Look, I'm sure there's going to be tons of confusion out there about whether this means you're going to slow in December or not. Would you say that the bias right now is not for another 75 basis point increase?
So what I want to do is put that question of pace in the context of our broader tightening program, if I may, and talk about the statement language along the way. So I think you can think about our tightening program as really addressing three questions. The first of which was, and has been, how fast to go. The second is how high to raise our policy rate. And the third will be eventually how long to remain at a restrictive level. So on the first question, how fast to tighten policy, it's been very important that we move expeditiously, and we have clearly done so. We've moved 3.75% since March, admittedly from a base of 0. It's a historically fast pace, and that's certainly appropriate, given the persistence and strength in inflation and the low level from which we started. So now we come to the second question, which is how high to raise our policy rate, and we're saying that we'd raise that rate to a level that's sufficiently restrictive to bring inflation to our 2% target over time, and we put that into our post-meeting statement. Because that really does become the important question, we think now, is how far to go, and I'll talk more about that. We think there's some ground to cover but before we meet that test, and that's why we say that ongoing rate increases will be appropriate. And as I mentioned, incoming data between the meetings, both the strong labor market report, but particularly the CPI report, do suggest to me that we may ultimately move to higher levels than we thought at the time of the September meeting. That level is very uncertain, though, and I would say, we're going to find it over time. Of course, with the lags between policy and economic activity, there's a lot of uncertainty. So we note that in determining the pace of future increases, we'll take into account the cumulative tightening of monetary policy as well as the lags with which monetary policy affects economic activity and inflation. So I would say as we come closer to that level, move more into restrictive territory, the question of speed becomes less important than the second and third questions. And that's why I've said at the last two press conferences that at some point it will become appropriate to slow the pace of increases. So that time is coming, and it may come as soon as the next meeting or the one after that. No decision has been made. It is likely we'll have a discussion about this at the next meeting, a discussion. To be clear, let me say again, the question of when to moderate the pace of increases is now much less important than the question of how high to raise rates and how long to keep monetary policy restrictive, which really will be our principal focus.
If I could follow up on that, to what degree was there an importance or weight given to a need to signal this possibility now, given all the concerns really around the globe about Fed policy sort of driving ahead and everybody else, dealing with their own stress as a result?
Well, I think I'm pleased that we have moved as fast as we have. I don't think we've over-tightened. I think there's very difficult to make a case that our current level is too tight, given that inflation still runs well above the federal funds rate. So I think that at this meeting, the last two meetings, as I've mentioned, I've said that there would come a point, and this was a meeting at which we had a discussion about what that might mean, and we did discuss this, and as I mentioned, we'll discuss it again in December. But there's I don't have any sense that we've over-tightened or moved too fast. I think it's been good and a successful program. That we've gotten this far this fast. Remember, though, that we still think there's a need for ongoing rate increases, and we have some ground left to cover here, and cover it we will.
Nick Tamarosa of the Wall Street Journal. Chair Powell, core PCE inflation on a 3 or 6 month annualized basis and on a 12-month basis has been running in the high 4s, close to 5%. Is there any reason to think you won't have to raise rates at least above that level to be confident that you are imparting enough restraint to bring inflation down?
So this is the question of does the policy rate need to get above the inflation rate? And I would say there are a range of views on that. That's the classic Taylor principle view. But I would think you'd look more at a forward, a forward-looking measure of inflation to look at that. But I think the answer is we'll want to get the policy rate to a level where it is where the real interest rate is positive. We will want to do that. I do not think of it as the single and only touchstone, though. I think you put some weight on that. You also put some weight on rates across the curve. Very few people borrow at the short end of at the federal funds rate, for example. So households and businesses, if they're very meaningfully positive interest rates all across the curve for them, credit spreads are larger, so borrowing rates are significantly higher, and I think financial conditions have tightened quite a bit. So I would look at that as an important feature. I'd put some weight on it, but I wouldn't say it's something that is the single dominant thing to look at.
If I could follow up, what is your best assessment or the staff's best assessment right now of the current rate of underlying inflation?
I don't have a specific number for you there. So there are many, many models that look at that. And I mean, one way to look at it is that it's a pretty stationary object, and that when inflation runs above that level, for sure, substantially above for some time, you'll see it move up, but the movement will be fairly gradual. So I think that's what the principal models would tend to say. But I wouldn't want to land on any one assessment. There are many different, as you know, many different people who publish an assessment of underlying inflation.
Thank you.
Hi, Chair Powell. Thank you for taking our questions. Gina Smilik, New York Times. I wonder, do you see any evidence at this stage that inflation is or is at risk of becoming entrenched?
Is inflation becoming entrenched? So I guess I would start by pointing to expectations. So if we saw longer-term expectations moving up, that would be very troubling. And they were moving up a little bit at the middle part of this year, and they've moved now back down. That's one piece of data. Shorter-term inflation expectations moved up between the last meeting and this meeting, and we don't think those are as indicative, but they may be important in the wage-setting process. There's a school of thought that believes that. So that's very concerning. I guess the other thing I would say is that the longer we have, we're now 18 months into this episode of high inflation, and we don't have a clearly identified scientific way of understanding at what point inflation becomes entrenched. And so the thing we need to do from a risk management standpoint is to use our tools forcefully but thoughtfully and get inflation under control, get it down to 2%, get it behind us. That's what we really need to do and what we're strongly committed to doing.
Rachel.
Hi, Chair Powell. Thank you for taking our questions. Rachel Siegel from the Washington Post. The statement points to lag times. I'm wondering if you can walk us through how you judge those lag effects, what that timeline looks like over the coming months or even a year, and where you would expect it to show up in different parts of the economy.
Yeah, so the way I would think about that is it's a commonly, for a long time, thought that monetary policy works with long and variable lags, and that it works first on financial conditions and then on economic activity and then perhaps later than that even on inflation. So that's been the thinking for a long time. There was an old literature that made those lags out to be fairly long. There's newer literature that says that they're shorter. And the truth is we don't have a lot of data of inflation of this high in what is now the modern economy. One big difference now is that it used to be that you would raise the federal funds rate, financial conditions would react, and then that would affect economic activity and inflation. Now, financial conditions react well before, in expectation of monetary policy. That's the way it has moved for a quarter of a century, is in the direction of financial conditions, then monetary policy, because the markets are thinking what is the central bank going to do. And there are plenty of economists that also think that once financial conditions change, that the effects on the economy are actually faster than they would have been before. We don't know that. I guess the thing that I would say is it's highly uncertain. And so from a risk management standpoint, it would be irresponsible not to ignore them, but you want to consider them but not take them literally. So I think it's a very difficult place to be, but I would tend to want to be in the middle, looking carefully at what's actually happening with the economy, and trying to make good decisions from a risk management standpoint, remembering, of course, that if we were to over-tighten, we could then use our tools strongly to support the economy. Whereas if we don't get inflation under control because we don't tighten enough, now we're in a situation where inflation will become entrenched, and the costs,
That's interesting.
the employment costs in particular, will be much higher potentially. So from a risk management standpoint, we want to be sure that we don't make the mistake of either failing to tighten enough or loosening policy too soon.
And if I could follow up, should we interpret the addition to the statement to mean that more weight is put into those lag effects than they would have been after previous rate hikes?
So I think as we move now into restrictive territory, as we make these ongoing rate hikes and policy becomes more restrictive, it'll be appropriate now to be thinking more about lag. Of course, we think about the lags are just sort of a basic part of monetary policy, but we will be thinking about them. But we won't be, I think we'll be considering them, but because it's appropriate to do so. Let me say this, it is very premature to be thinking about pausing. So people, when they hear lags, they think about a pause. It's very premature, in my view, to think about or be talking about pausing our rate hike. We have a ways to go. Our policy, we need ongoing rate hikes to get to that level of sufficiently restrictive, and we don't really know exactly where that is. We have a sense, and we'll write down in the December meeting a new summary of economic projections which updates that. But I would expect us to continue to update it based on what we're seeing with incoming data.
Ooh, new lows.
Thanks, Chair Powell. Neil Irwin with Axios. As you look around the economy, the clearest impact of your tightening so far has been on housing, maybe some venture-funded tech companies. It's been relatively narrow in terms of labor market, consumer demand, a lot of sectors.
The dollar, you
see a ton
guys.
of effect. Is the pathway and channels through which monetary policy works changing? Is it narrower than it used to be? And on housing in particular, are you at all worried that you're crimping housing supply in ways that might cause problems down the road?
I don't know that the channels through which policy works have changed that much. I would say a big channel is the labor market, and the labor market is just very, very strong, very strong. And households, of course, have strong balance sheets. And so we go into this with a strong labor market and excess demand in the labor market, as you can see through many different things, and also with households who have strong spending power built up. So it may take time. It may take resolve. It may take patience. It's likely to get inflation down. I think you see from our forecasts and others that it will take some time for inflation to come down. It'll take time, we think. Sorry, was I getting to your question there? Oh, housing, the housing part of it. Yeah, so, we look at housing. Of course, housing is significantly affected by these higher rates, which are really back where they were before the global financial crisis. They're not historically high, but they're much higher than they've been. And you're seeing housing activity decline. You're seeing housing prices growing at a faster rate, and in some parts of the country declining. I would say the housing market was very overheated for the couple of years after the pandemic as demand increased and rates were low. We all know the stories of how overheated the housing market was, prices going up, many, many bidders, no conditions, that kind of thing. So the housing market needs to get back into a balance between supply and demand. We're well aware of what's going on there. From a financial stability standpoint, we didn't see in this cycle the kinds of poor credit underwriting that we saw before the global financial crisis. Housing credit was very much more carefully managed by the lenders. So it's a very different situation and doesn't appear to present financial stability issues. But no, we do understand that that's really where a very big effect of our policies is.
Victoria.
Hi, Victoria Guida with Politico. I wanted to ask about the labor market. You mentioned early on again that job openings are very high compared to available workers, and I'm just curious to what extent you do and don't draw a signal from that. So, for example, if wage growth is slowing and if maybe the unemployment rate starts to tick up, will that make you sort of decrease your focus on job openings? What do you see? Are wages what's really important? How are you thinking about the labor market as it relates to inflation?
So we talk a lot about vacancies and the vacancy to unemployed rate, but it's just one. It's just another data series. It's been unusually important in this cycle because it's been so out of line. But so has quits, so have wages. So we look at a very wide range of data on the labor market. So I'd start with unemployment, which is typically the single statistic you would look to, is at a 50-year low, 3.5%. We're getting really nothing in labor supply now. We had, I think, a very small increase this year, which we had really thought we would get that back. Most analysts thought we would get some labor supply coming in. You mentioned wages, so I guess I would characterize that as sort of a mixed picture. It's true with average hourly earnings you see, so I would call it a flattening out at a level that's well above the level that would be consistent over time with 2% inflation, assuming a reasonable productivity. There with the ECI reading this week, again, a mixed picture. The headline number was a disappointment. Let's just say it was high. It didn't show a decline. There's some rays of light inside that if you look at private sector workers, that did come down, the compensation did come down. But overall, though, the broader picture is of an overheated labor market where demand substantially exceeds supply. Job creation still exceeds the sort of the level that would hold the market where it is. So that's the picture. Do we see, we keep looking for signs that sort of the beginning of a gradual softening is happening. And, maybe that's there, but it's not obvious to me because wages aren't coming down. They're just moving sideways at an elevated level, both ECI and average hourly earnings. We want to see, we would love to see vacancies coming down, quits coming down. They are coming down. Vacancies are below their all-time high, but not by as much as we thought because, and that, the data series is volatile. We never take any one reading. We always look at, 2 or 3. So it's a mixed picture. I don't see the case for real softening just yet, but we look at, as I just showed you, we look at a very broad range of data on the labor market.
So do you see wages as being a significant driver of inflation?
I think wages have an effect on inflation, and inflation has an effect on wages. I think that's always been the case. There's always a going back and forth. The question is that really elevated right now? I don't think so. I don't think wages are the principal story of why prices are going up. I don't think that. I also don't think that we see a wage price spiral. But again, it's not something you can, once you see it, you're in trouble. So we don't want to see it. We want wages to go up. We just want them to go up at a level that's sustainable and consistent with 2% inflation. And we do think that given the data that we have, that this labor market can soften without having to soften as much as history would indicate through the unemployment channel. It can soften through job openings declining. We think there's room for that, but we won't know that. That'll be discovered empirically.
Thank you so much. Kayla Tausche from CNBC. Earlier last month, the United Nations warned that there could be a global recession if central banks didn't change course. The new UK Prime Minister warned of a profound economic crisis there. And I'm wondering how the Fed is weighing international developments in light of a very strong economy here in the U.S. that would seem to be bucking those trends.
So, of course, we keep close tabs on economic developments and also geopolitical developments that are relevant to the economy abroad. We're in very frequent contact with our foreign counterparts, both through the IMF meetings and the regular meetings with central banks that we have, and I have one this weekend with many central bankers. So we're in touch with all of that. So I guess it's clearly a difficult time in the global economy. We're seeing very high inflation in Europe, significantly because of high energy prices related to the war in Ukraine. And, we're seeing China's having issues with the zero COVID policy and, much slower growth than we're used to seeing.
Looks like things
So
trying
we're
to bottom
seeing
here.
we see those difficulties. The strong dollar is a challenge for some countries, but we have it, and we take all of that into account in our models. We think about the spillovers and that sort of thing. Here in the United States, we have a strong economy, and we have an economy where inflation is running at 5%. Core PCE inflation, which is a really good indicator of what's going on for us, is the way we see it, is running at 5.1% on a 12-month basis, and sort of similar to that on a 3, 6, and 9-month basis. So we know that we need to use our tools to get inflation under control. The world's not going to be better off if we fail to do that. That's a task we need to do. Price stability in the United States is a good thing for the global economy over a long period of time. Price stability is the kind of thing that pays dividends for our economy for decades, hopefully. Even though it may be difficult to get it back, getting it back is something that provides value to the people we serve for the long run.
If I could just follow up on that. Thank you. The Fed has acknowledged in the past that the tools that you have don't affect things like energy and food prices that stem from some of those conflicts overseas, and they're some of the biggest pain points for consumers. So as you pursue the current path that you've outlined, is there a risk that some of those prices simply don't come down?
So we don't directly affect, for the most part, food and energy prices, but the demand channel does affect them just at the margin. The thing about the United States is that we also have strong, in many other jurisdictions, the principal problem really is energy. In the United States, we also have a demand issue. We've got an imbalance between demand and supply, which you see in many parts of the economy. So our tools are well suited to work on that problem, and that's what we're doing. You're right, though. We don't, the price of oil is set globally, and it's not something we can affect. I think by the actions that we take, though, we help keep longer-term inflation expectations anchored, and keep the public believing in 2% inflation by the things that we do, even in times when energy is part of the story of why inflation is high.
Hi, Chair Powell, Janelle Marte with Bloomberg. So the Fed is facing 2 more ethics-related incidents with the revision of the financial statements from President Bostic and President Bullard speaking at a closed event. So some senators, like Elizabeth Warren, are saying that this is a sign of greater ethics problems at the Fed. Could you talk about what this does to the public's trust in the bank and what the Fed is doing to prevent this kind of behavior from becoming common?
Sure. So you're right. The public's trust is really the Fed's and any central bank's most important asset. And anytime one of the policymakers violates or falls short of those rules, we do risk undermining that trust, and we take that very seriously. We do. So at the beginning of our meeting yesterday, actually, we had a committee discussion of the full committee on the importance of holding ourselves individually and collectively accountable for knowing and following the high standard that's set out in our existing rules with respect to both personal investment activities and external communications. We've taken a number of steps, and I would just say we do understand how important those issues are. I would say that our new investment program that we have is up now and running, and actually it was through that the problems with President Bostic's disclosures were discovered when he filed his new disclosures. We now have a central group here at the Board of Governors that looks into disclosures and follows them and approves people's disclosures, and also all of their trades. Any trade anyone has to make who's covered has to be pre-approved. And there's a lag. It has to be pre-approved 45 days before it happens, so there's no ability to game market. So it's a really good system. It worked here. And I think we all said to each other yesterday morning, we recommitted to each other and to this institution to hold ourselves to the highest standards and avoid these problems.
Do you have an update on the investigations that are pending?
I don't. So, as you know, I referred the matter concerning President Bostic to the Inspector General. And once that happens, I don't discuss it with the Inspector General or with anybody. It's just the Inspector General has He has the ability to do investigations. We don't really have that. So that's what he's doing.
Michael McKee from Bloomberg Television and Radio. Earlier this year, you touted the 3-month bill yield out to 18 months as the yield curve with 100% explanatory power. And you said, quote, if it's inverted, that means the Fed's going to cut, which means the economy is weak. That curve is only 2 basis points away from inversion now. So I'm wondering why you are so confident that you have not over-tightened, particularly given that rates work with a lag.
Well, so we do monitor the near-term forward spread. You're right, and that's been our preferred measure. We think it, just empirically, it dominates the ones that people tend to look at, which is 2s, 10s, and things like that. So it's not inverted, and also you have to look at why things, why the rate curve is doing what it's doing. It can be doing that because it expects cuts or because it expects inflation to come down. In this case, if you're in a situation where the markets are pricing in significant declines in inflation, that's going to affect the forward curve. So yes, we monitor it. You're right, and that's what I would say.
If I could follow up, you also said several meetings ago that the risk of doing too little outweighed the risk of doing too much. Is what you're trying to tell us today is that that risk assessment has changed a little bit?
Well, what's happened is time has passed, and we've raised interest rates by 375 basis points. I would not change a word in that statement, though. I think until we get inflation down, you'll be hearing that from me. Again, if we over-tighten, and we don't want to, we want to get this exactly right, but if we over-tighten, then we have the ability with our tools, which are powerful, to, as we showed at the beginning of the pandemic episode, we can support economic activity strongly if that happens, if that's necessary. On the other hand, if you make the mistake in the other direction and you let this drag on, then it's a year or two down the road and you're realizing inflation behaving the way it can, you're realizing that you didn't actually get it, you have to go back in. By then, the risk really is that it has become entrenched in people's thinking, and the record is that the employment costs, the cost to the people that we don't want to hurt, they go up with the passage of time. That's really how I look at it. So that isn't going to change. What has changed, though, you're right, is we're farther along now, and I think as we're farther along, we're now focused on that. What's the level we need to get to rates, and I don't know what we'll do when we get there. By the way, we'll have to see. There's been no decision or discussion around exactly what steps we would take at that point, but the first thing is to find your way there.
Thanks, Chris.
Thank you. Chris Rugaber at Associated Press. Just to go back to housing for a minute, you mentioned the impact that rate increases have had on housing. Home sales are down 25% in the past year and so forth, but none of this is really showing up, as you know, in the government's inflation measures. And as we go forward, private real-time data is clearly showing these hits to housing. Are you going to need to put a greater weight on that in order to ascertain things like whether there's over-tightening going on? Or will you still focus as much on the more lagging government indicators?
All right, Dwayne.
This is an interesting subject. So I start by saying, I guess, that the measure that's in the CPI and the PCE, it captures rents for all tenants, not just new leases. And that makes sense, actually, because for that reason, that conceptually, that's sort of the right target for monetary policy. And the same thing is true for owner's equivalent rent, which comes off of it's a reweighting of tenant rents. The private measures are of course good at picking up the at the margin the new leases, and they tell you a couple things. One thing is I think right now, if you look at the pattern of that series of the new leases, it's very pro-cyclical. So rents went up much more than the CPI and PCE rents did, and now they're coming down faster. So the implication is that there are still, as people as non-new leases roll over and become and expire, right? There's still in the pipeline, there's still some significant rate increases coming. okay? But at some point, once you get through that, the new leases are going to tell you that what they're telling you is there will come a point at which rent inflation will start to come down. But that point is well out from where we are now. So we're well aware of that, of course, and we look at it. And but I would say that in terms of what the right way to think about inflation really is to look at the measure that we do look at, but considering that we also know that at some point you'll see rents coming down.
Great. And just a quick follow. It looks like stock and bond markets are reacting positively to your announcement so far. Is that something you would wanted to see? Is that a problem, or how that might affect your future policy to see this positive reaction?
We're not targeting any one or two particular things. Our message should be, what I'm trying to do is make sure that our message is clear, which is that we think we have a ways to go. We have some ground to cover with interest rates before we get to that level of interest rates that we think is sufficiently restrictive. And putting that in the statement and identifying that as a goal is an important step. And that's meant to put that question really as the important one now going forward. I've also said that we think that the level of rates that we estimated in September, the incoming data suggests that that's actually going to be higher. And that's been the pattern. I mean, I would have little confidence that the forecast, if we made a forecast today, if we were doing an SEP today, the pattern has been that one after another, they go up, and, that'll end when it ends. But there's no sense that inflation is coming down. It just, if you look at I have a table of the last 12 months of 12-month readings, and there's really no pattern there. We're exactly where we were a year ago. So, okay. So I would also say it's premature to discuss pausing, and it's not something that we're thinking about. That's really not a conversation to be had now. We have a ways to go. And the last thing I'll say is that I would want people to understand our commitment to getting this done, and to not making the mistake of not doing enough, or the mistake of withdrawing our strong policy and doing that too soon. So I control those messages, and that's my job.
Edward Lawrence with Fox Business. Thank you, Fed Chairman. So how big of a headwind is all the fiscal spending to what the Federal Reserve is trying to do to get inflation back to the 2% target?
In theory, it was a headwind this year, but I do think the broader context is that you have households that have these significant amounts of savings and can keep spending. So I think those two things do tend to sort of counterbalance each other out. It appears consumer spending is still positive. It's at pretty modest growth levels. It's not shrinking, people are, the banks that deal with retail customers and many retailers will tell you that the consumers are still buying, and they're still, they're fine. So I don't know how big the fiscal headwinds are, and they haven't shown up in the way that we thought they would in restraining spending. So it must have to do with the savings that people have.
What about the spending? There's tens of billions yet to be spent. I mean, from the Inflation Reduction Act, the American Rescue Plan, CHIPS Act, bipartisan infrastructure bill. How does that play into your thinking about the future?
It's demand is going to have some support from those savings, and also from the strong demand that's still in the labor market. We still see pretty significant demand and a tightening labor market in some respects, although I think overall I would say it's not really tightening or loosening. So we see those things, and what those things tell us is that our job is going to require some resolve and some patience over time. We're going to have to stick with this. That's just we take all that as a given, but we know what our objective is and we know what our tools can do, and that's how we think about it.
Okay, so does the market rip once he shuts up, or
Marketplace.
do we go
I'm
lower? What
wondering,
do you guys think?
has the window for a soft landing narrowed? Do you still think it's possible?
Has it narrowed? Yes. Is it still possible? Yes. I think we've always said it was going to be difficult, but I think to the extent rates have to go higher and stay higher for longer, it becomes harder to to see the path, it's narrowed. I would say the path is narrowed over the course of the last year, really. Hard to say. Hard to say. You know, again, I would say that the sort of array of data in the labor market is highly unusual, and to many economists, there is a path to. Ordinarily, there's a relationship to GDP going down and vacancies declining, translating into unemployment, or there's Okun's law. So all those things are relationships that are in the data, and they're very real. Data's a little bit different this time, though, because you have this tremendously high level of vacancies, and we think on a very steep part of the beverage curve. All I would say is that the job losses may turn out to be less than would be indicated by those traditional measures because job openings are so elevated and because the labor market is so strong. Again, that's going to be something we discover empirically. I think no one knows whether there's going to be a recession or not, and if so, how bad that recession would be. And our job is to restore price stability so that we can have a strong labor market that benefits all over time, and that's what we're going to do.
But just real quickly, why do you feel like the window has narrowed?
Because we haven't seen inflation coming down. The implication of inflation not coming down, and what we would expect by now to have seen is that as the supply side problems had resolved themselves, we would have expected goods inflation to come down by now, long since by now. And it really hasn't, although it has come down, but it's not to the extent we had hoped. At the same time, now you see services inflation, core services inflation moving up, and I just think that the inflation picture has become more and more challenging over the course of this year, without question. That means that we have to have policy be more restrictive, and that narrows the path to a soft landing.
That's interesting, MDJ.
Thanks very much.
Moment of truth here. Well, there it is. The event has now ended. What do we think? What do we think? How are we feeling? Are we feeling any better? Are we feeling much worse? I really don't know how I feel. Certainly feels like we might be about to make new lows on the day, at least. That certainly seems possible. There will be no buyers. No buyers of what, though? Your puts went negative 75 and now they're up 200. Hey, that's what's up. I don't know. I kind of wonder, since he's done talking, like maybe markets will continue to kind of just shrug it off. I don't know. I'm not really sure. I'm not sure what to think. All we can do is really just watch price action, right? And kind of see where it goes. Doesn't look great. Well, guys, I really appreciate everybody coming and hanging out with me today. I do appreciate it. You're not buying the soft landing. Yeah, Kaiser, I mean, can't really blame you. Can't really blame you at all. A couple of things before I get out of here. Pop back over here to my single charts so that we can kind of keep watching what's going on. Oscar, man, cheers. Thank you. I appreciate it. A couple of things before I get out of here. Up here in the top right corner of your accounts, there's a question button. There's a bunch of information here. Vibrance, no problem, man. Happy to be here. Shiv Kumar, yeah, always a pleasure to see you too, bud. A couple of things to be mindful of. The official Discord, if you're interested in coming and being a member of our Discord, there's a link to it right here. Next thing to note, down here, bottom right-hand corner where it says Contact Us is a direct feed into our employee chat room. These guys are here every single day, Monday through Sunday. During the week, there are folks who are live about 20 hours per day. On the weekends, it's about 8 hours per day. If you guys have any questions about anything related to the TrendSpider platform, you are more than welcome to hit us up anytime. We are here to answer your questions, myself included. I don't hang out in chat, but I, of course, am on Twitter. I'm live here from time to time. Anytime you have any questions about anything. No, Discord is free, Oscar. Discord is free. Feel free to hit us up with any questions that you have about TrendSpider. Feel free to hit me up personally with any questions via my Twitter. My DMs are open if ever you guys need anything, or just hit me up, holler at me. Would love to help you guys with anything that you need. And then I guess last thing is we've got another live stream coming up next week. We're going to be talking Oxy. We're going to be talking about oil. We're talking Oxy earnings. And let me make sure when that is. That is next Tuesday, November 8th. So come hang out with me for Oxy earnings. They're after the bell, so I'll be live probably like half an hour or so before the bell, and we'll keep an eye on Oxy for its earnings announcement. Maybe we'll do a little giveaway. We'll do like a Guess the Open for Oxy for Wednesday after its earnings. Yeah, that's it for me, guys. I really, really appreciate you all being here, hanging out with me, hanging out with our good friend Jerome. And we thought maybe he was going to help us out today. It looks like he does not want to help us out today. It looks like he wants to hurt us today. But maybe tomorrow will be a better day. I don't know. We'll see. Hopefully. If you were trading alongside, hope you were able to get out of those trades safely. If you were trading the short side, congratulations. You crushed it. I know Braden did. That is one trader I know nailed it today. So everybody give a hand of applause to Braden. He top ticked that thing. So good job, Braden. Again, thank you all for being here. I hope you have a great rest of your week. Safe trading out there. This price action is crazy. Holler at me or holler at us in chat if you guys need anything. And hopefully we'll see you next week for Oxy earnings on Tuesday. Until then, be good. Have fun. Learn a lot. My dad used to always tell me that when I was a young kid going to school. And we'll see y'all soon. All right, take care. Bye.